For the week ending July 6, 2026, the global macroeconomic picture moved directly into the center of Canadian retail portfolios. The primary catalyst arrived on July 2nd when the U.S. Bureau of Labor Statistics released its latest jobs report. Economists expected 113,000 jobs. The BLS reported only 57,000 added in June, less than half the forecast. This miss forced a recalculation of expectations for the July 30th FOMC decision, with the market pricing in a scenario where the Federal Reserve maintains its current rate hold. This shift created an immediate conflict for the many investors who had positioned their portfolios bond light in anticipation of a July rate increase. When investors brace for a hike but the Fed holds steady, the mismatch reprices interest-sensitive assets like real estate investment trusts. For a $60,000 baseline allocation in U.S. REITs, the cost of positioning for a hike that doesn't arrive is exactly $1,800. It is a reminder that macroeconomic beta points are the specific mechanisms that dictate the daily value of a standard retirement portfolio. In the digital asset sector, the week was defined by a gap between retail liquidations and a sudden surge in institutional capital. On June 27th, the block reported spot Bitcoin ETFs shed $1.79 billion in a single week. It was the second worst weekly exodus since the funds launched in early 2024. The retail reality of this volatility is stark. The average investor holding BlackRock's IBID is now down roughly 40% from their initial entry point. This line graph maps that institutional drain against an abrupt reversal. On July 3rd, CoinDesk reported the end of a $2.73 billion outflow streak. The fund saw $221.7 million in fresh net inflows. Fidelity's FBTC led the recovery, securing $165.96 million in new capital. However, the recovery isn't universal. BlackRock's IBIT remained the lone holdout of the week, continuing to bleed $40 million in assets. While retail investors navigated the ETF market, a separate lane of corporate accumulation continued to scale in Japan. On July 2nd, Japanese firm Metaplanet purchased 2,823 Bitcoin for $170.7 million. This purchase pushes Metaplanet's total holdings to 43,000 Bitcoin, valued at $2.6 billion. On the global leaderboard of public holders, they now sit behind only Strategy and 21 Capital. This positions Metaplanet as the world's third largest public Bitcoin holder, signaling a significant shift in corporate treasury strategies. Global markets create headlines, but for the Canadian investor, the most permanent damage often comes from silent structural drains. Inside an RRSP, the cost difference between a standard bank equity mutual fund and an all-cap Canadian ETF, like Vanguard's VCN, is massive over time. This chart tracks two identical starting balances. Vanguard's VCN charges an annual fee of 0.05%, while the average bank equity mutual fund charges 2.2%. On a $100,000 balance, that fee discrepancy results in the bank fund erasing over $127,000 from the household over a 20-year period. That total equates to a silent drag of $6,350 being removed from the portfolio every single year. A similar mechanical drain occurs when investors hold U.S. dividend-paying stocks inside a tax-free savings account. Because the TFSA is not recognized by the U.S.-Canada tax treaty for these assets, the IRS withholds 15% on every U.S. dividend paid to Canadian investors in these accounts. This withholding amounts to $525 in unrecoverable taxes every year. When you account for the lost compound growth that money would have generated over 25 years, the total loss to the portfolio reaches $62,000. For those with defined benefit pensions, a highly specific reporting error can trigger immediate and costly penalties from the CRA. The issue centers on Box 52 of the T4 slip, the pension adjustment. If this box remains unfiled or incorrect, the CRA applies a penalty of exactly $154 for every month the error persists. Over the course of a year, this silent penalty adds up to $1,848. Whether a Washington jobs report or a single T4 box, long-term wealth preservation relies entirely on understanding these quiet mechanics of data and fees.